Texas Instruments stock is down 3.49% right after reporting its Q3 earnings. This is a continuation of the 2023 decline, seeing the price fall 23.8% from its July peak. So what happened? Texas Instruments is widely considered one of the best dividend growth stocks you can buy. It has 20 years of consecutive dividend growth. From 2004 to 2022, the dividend has grown at a 25% compound annual growth rate. While slowing in recent years, it's often well above 10%. This is accomplished by the company's extreme focus on growing free cash flow per share. It's such a priority that it's the first thing on TI's investor relations page. Aside from dividends, that free cash flow has fueled a massive share repurchase program. In that same 2004 to 2022 time period, there has been a 47% reduction in share count. This is massive and cannot be understated. These factors allowed Texas Instruments stock to deliver fantastic returns for investors. Given the stock's great history, I am surprisingly not buying the dip for my long-term dividend growth stock portfolio. In this video, I'm going to dive into the latest financial performance and explain why this crash in Texas Instruments stock may just be the beginning. Finally, I'll share whether I will sell my entire position right now. Buckle up, we've got a good video ahead. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using the stock research tool I personally developed, which is available at dividenddata.com. Here you can do deep financial analysis on over 7,500 stocks, helping you find better investments. Link in the description and pinned comment. Texas Instruments, ticker symbol TXN, has had a bad 2023. Earnings per share is down significantly year over year, getting worse after every quarter. This is mostly due to a slowdown in the overall semiconductor market outside of chips directly and indirectly related to the recent AI spending cycle. However, this dip in earnings is not the biggest problem with the stock. The real issue is free cash flow. It has collapsed over the past 3 quarters. Why? Operating cash flow has only declined slightly in line with recent earnings. What happened is that capital expenditures have ballooned to just under $1.5 billion a quarter. This drove free cash flow down dramatically, even going negative in 2023 Q2. So how bad is it? For context, the company's quarterly dividend payment is about $1.12 billion. That means the dividend payment is well above free cash flow for 3 quarters in a row. This is operating at a loss. The dividend is being paid with either debt or cash from the balance sheet. Luckily, the company has a strong balance sheet with $8.9 billion in cash on hand and only $2.2 billion in net debt. But it's still not a good sign. As a dividend growth investor, this is where I start to get concerned. So what has Texas Instruments actually spent all the capex on? They are building out multiple high-end semiconductor fabrication plants. Now, I like intelligent long-term investments as much as anyone else, but this is an extreme increase compared to historic norms. It is a major change from how the business has been run. Why the change? The US government has given massive incentives to build domestic chip fabs for national security reasons. We'll talk more about those incentives later. As a US citizen, I like the strategy. As an investor, I am concerned about the spending levels. But how long could they really sustain this level of spending? It had to be short term, right? Wrong. I listened to the Texas Instruments Q3 earnings call to find out more information. The analysts asking questions were just as concerned as me. They asked whether the company had any plans to reduce capex spending. The management responded by saying they expect to have $5 billion in annual capex during fiscal 2023, 2024, 2025, and 2026. That is a long time. This is double the spending of fiscal 2022 and over 5 times their typical typical annual capital expenditures. They are basically saying that the dividend will not be financially sustainable through the end of 2026. The 2022 free cash flow payout ratio of the dividend was already high at 72.55%. Dividend growth has already slowed to reflect this strategy change. The latest increase was only 4.84%. I'd expect this to stay slow and maybe even decline more. Additionally, share repurchases have all but stopped. The company simply does not have excess cash flow to reward shareholders like they used to. These government incentives must be worth it. Let's take a look at that. On the earnings call, they mentioned that they will be receiving a 25% tax credit on everything that is spent on CapEx in the US for fabs. But they said that this will only apply to $4 billion of the $20 billion they are investing, since some of it is international. They've already accrued approximately $1.2 billion from this, but they do not estimate it will be available as cash until 2024 Q4. On top of this, Texas Instruments is applying for a grant from the CHIPS Act. Note the word applying. These are not guaranteed. The total of the CHIPS Act is $52 billion, and there are many companies hoping to benefit from this. Most notably, Intel, which spent $25 billion last year alone on CapEx. This will be a lot of government lobbying by companies to make sure they get these grants. On Texas Instruments' side, they do have $2 billion set aside for the legacy chips used in automobiles and defense systems. Texas Instruments dominates that industry, so I assume they will be a large portion of that money pool. While great incentives, this is far from fully paying for their planned $20 billion in capital expenditures through 2026. Initially, all this money is coming out of Texas Instruments' pockets. Some of it will be coming back, but it's still a massive increase even netting out the incentives. For Texas Instruments stock, this means low dividend growth and little to no buybacks through at least 2026. With continued negative free cash flows, most financial metrics will begin to look quite poor for the company. Investors will certainly continue flowing out of the stock. I've learned that lesson the hard way with my failed Intel investment. This is not the bottom. Personally, I think it's unlikely Texas Instruments will be forced to reduce their dividend payment, but that is what Intel did with their 65% cut of their long-growing dividend. So what am I doing with my Texas Instruments stock? I'm going to sell right away and reinvest the money elsewhere. I am not going to sit around and wait for all of this to play out. I've learned from Intel. Negative to low free cash flow, unsustainable dividends, and a declining semiconductor market will kick the stock in the butt. I do not see it doing well over the next couple of years. That said, Texas Instruments is still a great company with a dominant market position. This is likely not goodbye forever. I will likely look to buy back into the stock in 2025 or 2026 at what hopefully is a more attractive valuation. So what am I doing with the $4,000 from my TXN stock? I'm buying Visa stock, which just grew its dividend 15%. I'll make a video in the coming days explaining why. Make sure you leave a like, share, and subscribe to the channel if this video provided value. Sign up for dividenddata.com if you want to use the research tool I've been showing throughout. If the software helps you identify just one slightly better stock, then it pays for itself. Here you also gain access to my portfolio tracker, which provides unique insights for the dividend-focused investor. Feel free to watch my old Texas Instruments stock review video to dive deeper into the company's business model. Thanks for watching.